Thank you for joining Ravenpack's 5th Chat with the Experts webinar, where we will be discussing ESG investing post-COVID. You will see we have some resources available to download on the right side of the screen, being a few research papers from Ravenpack, as well as a video introducing our publicly available coronavirus monitor. I suggest you download these before the end of the webinar while they are still available. Before we begin, I'd like to say on behalf of Ravenpack and MSCI that the human cost of the coronavirus strategy has been great, and our thoughts are with all those who have lost loved ones. Without wishing to make light of terrible human suffering that has accompanied the pandemic, today's webinar will focus primarily on the economic rather than the humanitarian aspects of the crisis. It is clear the corona pandemic marks a turning point for states, companies, families, and for financial markets. But what is happening now in the field of sustainable investing? Are we at a turning point here too? This is what we are going to discuss as part of our session today. With me, I have Noel Friedman, Executive Director of ESG Ratings at MSCI. Hi, Noel. Welcome to the webinar. Could you please tell a little bit about yourself to start off with?
Thanks, Peter. And again, I want to thank you and thank Ravenpack for hosting this webinar, and thank everybody for attending, and echo your sentiments in terms of the challenges that everybody's been going through, and appreciate everybody attending, and our thoughts go out to everybody, and hope everybody is healthy and safe. So yeah, I've been in the ESG space for over 20 years now, starting at a boutique ESG firm, and that was acquired and became a part of MSCI about 10 years ago. So I've seen ESG grow from sort of the very small niche industry it was, in the late 90s, to sort of what is increasingly a significant part of many or most of the asset managers' core investment process. So that's kind of my history, and I sort of manage the ESG ratings and ESG business for the Americas region on a day-to-day basis.
Perfect, thanks. And my name is Peter Hoffis. I'm the Chief Data Scientist here at Ravenpack. I've had the pleasure of working for more than 11 years, inspiring the industry on how to take advantage of NLP-driven sentiment and event data across multi-asset class investment processes. Prior to Ravenpack, I worked as a quant researcher at Standard & Poor's and Credit Suisse First Boston in London, and at Saxo Bank in Copenhagen. Today, we're going to use Slido to submit all questions and run interactive polls. So if everyone can go to slido.com and put in the code ESG_investing, it would be very much appreciated. It will allow us to have as interactive a session as possible. And to ensure that all our listeners are awake at this stage, let's kick it off with a poll question. The first question that we would like to ask is your firm currently offering ESG-driven strategies? And as you answer the question, Noel and I will move on to the first question, and we'll come back to your answers in a second. So sustainability in investing aims to define and address the greatest challenges facing our society, such as climate change, the ongoing violation of human rights, social imbalances, and corporate governance. And that sort of leads us on to, do you think, Noel, that sustainable investing will become an integral part of our investment building blocks, or is it just a passing fad?
Yeah, I mean, I think we used to hear, what I would call that misconception sort of a while ago. I think increasingly, we view it, I think many of our clients, many asset managers view it as already having become kind of an integral part of the investment process. I think if you talk to many institutional asset managers today, their ability to win a mandate without demonstrating a systematic process to integrate ESG into portfolio management, risk management, is their ability to win those mandates without that is increasingly difficult. And I think that's particularly true in Europe, but increasingly in APAC, in Canada, at least in the coasts of the US, if not everywhere across the US. And I think that trend only seems to be continuing as we see asset owners and investment consultants sort of increase their expectations of asset managers around ESG integration. The RFP questions are getting harder, and they're getting to be more of them. They're seeking kind of integration, ESG integration and consistency across the front, middle, and back office. They want not just an ESG spokesperson to be able to talk about ESG, but they want every portfolio manager and analyst that they talk to be able to articulate the ESG strategy. And that ESG strategy is expected to be thoughtful and value adding to the investment process. And I think, and that's from the asset owner perspective. And I think, from there, responding to that demand, we've seen, and we work with most of the large investment consultants who have, built out ESG practices or come out with their own ESG ratings, assessing, asset managers' ability to integrate ESG into the investment process. And that's not even saying anything of kind of retail and wealth. In the last few years, we've seen, most of the large broker dealers, most online brokerage platforms offering some type of ESG and impact platform or some type of ESG tools to their investors. So I think even if asset managers wanted to avoid ESG investing, they really can't. And I think, as you see on the screen, I think increasingly asset managers are not looking to avoid ESG, but they're looking to take advantage of ESG. I think we've seen it, as you mentioned, in the COVID crisis, with human capital, labor management, supply chain issues becoming extremely relevant issues to companies, and as well as sort of a growing body of kind of anecdotal and quantitative evidence that failing to manage ESG risks has significant consequences for companies and investors. So that's Equifax, it's PG&E, it's TalkTalk, it's Volkswagen. And it's all these companies had low ESG ratings because they were failing to manage their ESG risks or positioning themselves well, effectively relative to these major ESG trends. And maybe just to make this a little more concrete, thinking of Equifax, that was a company that, if you remember, it's a couple of years ago now, but they had a significant data breach, and prior to that, we had seen that they had significant exposure on data and privacy issues. We saw a lack of sort of systematic management policies, systems to kind of manage and oversee data and privacy issues, and we saw sort of a pattern of smaller breaches. So all those things pointed to unmanaged ESG risk. We gave them our lowest rating, a CCC, in 2016. And then about a year later, they had that major data breach. I think it was something like 140 million customers were affected. A little bit later, their CEO resigned. They had a 25% drop in stock price. So all that's to say that, I think, seeing these sort of event-driven kind of this anecdotal evidence, and then, the sort of the quantitative evidence, that we've seen and written about in our studies, and a growing number of investors have written about, that companies that are demonstrating that they are more effectively managing ESG risk, and the slide that's on screen, we've seen that they have consistently higher profitability, lower tail risk, and lower systematic risk. So again, I think all those reasons are kind of both the demand and kind of the sort of growing evidence of financial relevance is why I think increasingly it's become sort of a kind of it's already part of the core investment building blocks.
Yeah, I think that echoes quite well what we're seeing in the marketplace as well. I mean, sometimes when we walk into client meetings, it's sometimes easier to sell an ESG story than an alpha story, or that's at least what they want from us when they need to have their budgets approved by management. So it's been quite a shift we've seen over the last couple of years. But
yeah, I think my colleagues feel the same way, that are in the non-ESG business. They go in to talk about something else, and people increasingly just want to talk about ESG.
Yeah, exactly. But why is it? I mean, if we start to look at why this is happening now, it's really exploded over the last couple of years, and also globally, as you pointed out. But why is it happening now? I mean, it's been around for a while.
Yeah, maybe if we flip to the next slide, obviously it's complicated, and it's to try and boil it down to a handful of reasons, and I'm not sure if we're technical difficulties. If we can flip to the next slide, I think maybe there's one in between, one back. I think maybe we jumped ahead before. If we go back to 3, sorry, there we go. So yeah, I think you're trying to kind of boil this down into sort of a handful of reasons, because as you said, I mean, I've been in the space for 20 years, and for at least 10, and for all of my colleagues who were in it 10, 20 years before that, ESG was sort of a very niche sort of small, at most 10% of the marketplace. But I think first and foremost, I would say that investors, large asset owners in particular, have increased access to information and increased awareness of ESG risks, and have less tolerance for a failure to manage those ESG risks. So I mean, I think if you look at 30 years ago, when the Exxon Valdez incident happened, the stock price barely moved. But as I mentioned with Equifax, and I think we've seen it, I mentioned a few other examples, but Equifax, after their major ESG issues, stock price 25%. I think Vale, when they had that major mine collapse in South America, their stock dropped similar, about 25%. Valiant, with their drug pricing issues, dropped over 70%. So I think investors, you can't sort of hide these things, sweep these things under the rugs, and investors are increasingly sort of less tolerant of those sort of mismanagement, those failures, and I think. And it's not just an awareness. I think it's also sort of that growing body of evidence that we've seen. I think that investors are sort of increasingly aware that effectively managing ESG risks is beneficial not only to the companies they invest in, but to their constituents. So having an ESG strategy, effectively managing ESG risk, effectively integrating ESG into the investment process has financial benefits. And I think what kind of is building on this momentum is it's moved beyond kind of talk to action. The couple of graphs on the screen here show sort of the commitments that on the left side is PRI signatories. So on some level that's just a commitment, but they've all signed the piece of paper that says that they're committed to integrating ESG across all of their assets. And then I think the slide on the right is one indication of them not just saying it, but doing something about it. And we've seen many large asset owners commit significant assets to ESG strategies. CalSTRS and others have allocated significant. I think CalSTRS allocated something like over $2 billion to a low carbon strategy. I think last year one of the Nordic pension funds, Ilmarinen, allocated I think over $1.5 billion to ESG ETFs linked to MSCI ESG indexes. And there's Swiss Re changing all of their benchmarks to ESG benchmarks. So I think all of those demonstrate a commitment that means that they're taking this seriously. And and there's also assets to be attracted by effectively demonstrating that you're integrating ESG into your investment process. And all of this is underpinned by the ability to differentiate between companies, to understand who's managing ESG risks well, who's failing, who's an ESG laggard, and sort of having sort of robust ESG ratings that allow you to make those differentiations and build a portfolio of strong ESG performers or lower ESG risk.
A lot of that is supported by an increasingly tough regulatory environment, especially in Europe. There's a lot of work going on, right? So I guess that's also sort of supporting that timing, and something we'll sort of discuss later. Let's try and take a look at the results of the first poll question, and I guess not surprisingly, people have a strong interest amongst the audience on ESG, and we can see that about 2/3 of the audience has an ESG product already in place. Most have launched their products within the last 3 years. However, another sort of close to a third has launched more than 3 years ago. We are also seeing about 20% of audience, or the answers at least, are looking to launch the first strategy. So hopefully they can learn something from or get inspired by some of our discussions today. And we take the 15% and try to flip them over to surely launching an ESG fund, and we would be happy to help them do that from the analytical side. And interestingly, no one here thinks that it's a fad, so that's good. That's good. Let's try and move straight on to poll question number 2 before we move on to the next question, the next discussion point. So the next poll question will be about how the audience is taking ESG issues into consideration in their investment process, in the investment analysis and decisions. And of course, this is more relevant to the 2/3 that already run strategies, but also to some extent, I would say, to the people that are currently looking to integrate it. How are they planning to integrate ESG into their investment analysis? So while this is running, I mean, many people argue that sustainable investing primarily involves screening out so-called sin stocks that have exposure to the likes of alcohol, tobacco, weapons, fossil fuel, or casinos, and so on. Is that still how things are done, or have we moved beyond these simple screening approaches?
Yeah, it's a good point. It's a good question, Peter. And also, I think we're ahead one slide again. If we can flip back the previous slide. But I think, to your question, I think seems like we're most of the callers on the line are not the uninitiated. But I think when we have those early conversations with clients who are thinking about ESG, one of the misconceptions, sort of maybe what they thought, ESG was, was what it was, 20, 30 years ago, which was all about negative screening. It was, they assumed that it was, removing tobacco companies from the portfolio and limiting your investment universe. But I think everything that we've been talking about for the first 10 minutes here, all the momentum, the trends around ESG investing, and sort of this belief that ESG creates sort of financial benefit from effectively integrating it into the investment process, impacts positively long-term risk-adjusted returns. This is ESG integration. This is not screening out companies. And I think it's a view that ESG factors are really sort of another source of independent research, providing some insights that are not captured in the traditional investment analysis process. So I think there's still plenty of clients, still plenty of pension funds in Europe who are screening out companies, companies that are involved in controversial weapons or breaches of sort of UN global norms or things like that. But I think when asset owners, investment consultants are pushing asset managers to integrate ESG across the investment process, what they're talking about is ESG integration, looking at ESG as a risk factor. And again, this belief, as you see on the right side of the screen here, that integrating ESG across the investment as another input into the investment process has the potential to positively impact long-term risk-adjusted returns.
Yeah, I think the answers are in on the poll question as well, and also in line with what you were just saying. I mean, 2/3 are having ESG integration in the investment analysis and decision making, and only 11% would point towards more exclusionary screening approaches. We're also seeing best-in-class investing and positive alignment and active ownership coming in up high, but really the one that stands out is a full-on integration within the investment analysis and decision making. So that's quite interesting. Let's take the last poll question of the day, and I'll also bring up a couple of the questions that have come in from the audience while we wait for the results. So the last question will be: will sustainable investing fall victim to the survival mode of companies and economies? So now we are having perhaps a little bit more of a COVID-related question here. Let's before we sort of start discussing ESG in relations to COVID and how that has impacted the integration, let's take, as I mentioned, a couple of questions from the audience. And one of the questions that came in related to regulation, which we sort of briefly touched upon a second ago. So the question goes, how big do you assess the global impact of the upcoming EU rules on sustainable finance will be? So here we're talking about the EU taxonomy, low carbon benchmarks, and so on.
Yeah, I mean, there's a lot that still is to be determined in terms of, what the final taxonomy is going to look like, what the final regulations are going to look like. Is there going to be recalibrations of sort of the wide scope of the regulations? But I think, we've already talked about, and I think we've already seen, ESG's past that tipping point, and it's more often that you're going to see the poll answers that we see, 2/3 are doing it, and the rest are thinking about it or are close to doing something about it. But I think what this starts to do is kind of codify that. It kind of provide create some standards, some frameworks around what the expectations are, and the EU regulations are quite broad. And I think it's sort of the every dimension of the investment process. There's a comply or explain. There's the sort of the ability to get have an ESG label on your fund. There's going to be specific standards on that. So I think all asset managers are going to be have an expectation to be able to talk about how if they're integrating ESG in the investment process, and how all sort of wealth managers, advisors are going to have to talk to their clients about whether they have ESG preferences. If you have an ESG product or a climate product, there's going to be certain requirements that you have to meet, or certain reporting standards you have to meet to receive sort of the the label. And so I think that it's going to have a significant kind of accelerator on the momentum, particularly around on climate adoption. And at MSCI, there's index regulations that came out first, and we've we were in a good position for it, but we put out ESG characteristics not just on our ESG indexes, which is what was required, but on all indexes. And I think that that sort of starts to set the stage for if you can get that ESG information on your benchmarks, you're going to want to start to see that ESG information on your portfolios. We've started to build out some templates, portfolio reporting templates, to help our clients kind of match those, what the regulations are asking for already for climate benchmarks and ESG benchmarks, with the expectation that asset owners, consultants are going to start to ask the same things from portfolios as well. So yeah, I think it's going to have a wide sort of wide significant impact, and kind of really put the accelerator on what's already pretty fast momentum.
And I guess as well in this process, there will be extra pressure on the analytical side to be able to integrate the regulation, and also you're seeing part of the regulation is also about speed in which you have to react if, let's say, an ESG event takes place. But we'll talk more about analytics later in the call as well. And I can see there's now we talked about indices a little bit, and there's a question from the audience here that talks about if we think that the biases, so you think that the biases which indices can place on the S, the G separately include a number of smaller companies from being noticed by investors?
Yeah, I think if I understood the question, that's sort of kind of assuming that there's maybe like a large cap bias, that companies with sort of more resources are going to be able to more effectively manage ESG. And I think if that's kind of, I think historically that might have been the case. I think we even saw it with our own ratings, and we've been working to manage that cap bias. But I think one thing that when we tried to build our ratings model is build it so that we weren't reliant on company disclosures, so that it wasn't necessarily just looking at which companies were disclosing more, but also when we look at our ratings, we're really looking at how how exposed a company is to ESG risks and how effectively they're managing those risks. And this is sort of a blanket statement, but I mean, large cap companies tend to be more exposed to ESG risks, so their expectations for ESG risk management are higher. Smaller companies, have lower risk exposure and tend to have, sort of then lower expectations. So I think, a number of those dimensions means that, it doesn't mean that if you're a big company that you're automatically going to have a good ESG rating, and if you're a small company. So I think, that's the way the ESG indexes, at least the MSCI ESG indexes, are constructed using the ratings means that, it's not biased towards large cap companies. And I think, the other bias, maybe answering a question that people are thinking that didn't ask, about sector bias, are the ESG indexes, sort of all tech and healthcare and software and not any, industrials and oil and gas. But, our ratings are designed to be kind of industry relative, so that we're looking at oil and gas companies relative to oil and gas companies. How are they effectively managing their industry specific risks relative to, best practices and worst practices, so that there aren't just going to be all the oil and gas companies are low rated and all tech. They have different ESG risks, and we're looking at how effectively we're managing those risks. And the indexes take the top companies in each industry, to have a similar sort of sector representation as the parent benchmark. So the goal is to sort of remove those biases that may have previously existed in an ESG portfolio.
Yeah, I think, it's all about the normalization that is taking place in the index construction or even in the portfolio construction, because there are, of course, some sources that naturally will introduce bias. If you look at large companies, they also have bigger media agencies working for them, or PR teams and so on, and therefore they can probably communicate more than the smaller names. However, the smaller names, if something hits, they surely will make it to the news, for instance, as an example, right? But as mentioned, it's something that is controlled for in the index creation and how you extract scores from that sort of content. Let's take a look at the answer to the poll question. So again, will sustainable investing fall victim to the survival mode of companies and economies during now with the COVID virus out there, coronavirus out there? So I would almost 50% of people think that it will not, that it's still going to be the biggest challenge facing society, both today and in the future. So there won't be any sort of negative impact on adoption there, but we still have almost 1/3 that thinks that it will slow it down to some extent. But let's see. It could be that we are changing people's minds throughout the webinar here, but still a large part thinks that it will, of the audience thinks that it will continue being the main driver, one of the main challenges. So if we look at given the global pandemic and the high likelihood of severe global recessions, are we not facing the risk of sustainable investing simply being dismissed as an unnecessary distraction? So we're going to discuss this a little more. That is, do you think that sustainability will fall victim to the survival mode of companies in their efforts to retain the status quo? What's your view on that? Now we've given the audience sort of their take on it.
Yeah, well, I guess from my sort of current work-life balance or lack thereof, the ESG demand is sort of not slowing down at all. But in seriousness though, I think we view, and I think we'll be aligned with that 46% of the respondents, and I think most of the asset managers and investors that we talk to, I think they're increasingly recognizing that, and the companies themselves, that effectively managing ESG risks is really critical to a company's survival and not a distraction. And I think it's, if you're focused on the right ESG issues, then you're really talking about concerns that are critical to a company's core business, their ability to attain, or the availability of, natural resources, the ability to attract talent, manage their human capital, the strength of their governance structures to either avoid or sort of withstand a crisis, or really, you know, kind of ultimately measuring a company's sort of resiliency or adaptability. You know, and I think, you know, with, as COVID, you know, changes how, you know, we think about business, you know, rapidly changing technology, you know, the ability to adapt and survive is, you know, not a distraction, but really is mission critical. And on some level, I think that's really what ESG is measuring. So I think, you know, I think that, and I think growing investors really view that, you know, it is mission critical when we're talking about, you know, kind of the material, the key ESG issues. They really are kind of core to a company's business.
Yeah, and I think the pandemic has shown some fragility in the global trade and in the supply chains. And in addition, we have seen human capital also has shown to be critical to certain types of businesses. Do you think that the COVID pandemic has changed how we view ESG? For instance, the S seems to have been getting a lot of focus these days.
Yeah, I mean, as you said, I think there's lots of there's short-term issues, you know, with human capital, supply chain issues, employee safety issues. But I think, you know, as I think we're all noticing, you know, sort of COVID, you know, is really, you know, changing the way that, you know, we think about business, how businesses are run, and therefore has the potential to change how we think about ESG. You know, so I think, you know, some of the things that we've started to think about, again, we don't really know yet, and we haven't, you know, changed our ESG framework, but I think, you know, there's questions that as you reflect back, it's, you know, will healthcare companies and pharmaceutical companies be incentivized to focus on global health issues versus designer drugs? Or, you know, and looking at the slide on screen, I mean, you know, when we historically thought about health and safety issues, we thought about fatalities and lost time injury rates, you know, but are we going to start thinking about, you know, industries where, you know, how close that you have to work with, you know, like in airlines, in food retail, in drug retail, you know, in leisure, you know, how close you have to work in proximity to other workers or to your customers? Is that sort of a new dimension of how you think about health and safety? Green building, will green building get another boost? Because, you know, one of the key focuses of green building, of LEED certification, is air quality. And with, you know, an increased emphasis on air quality, will that also kind of provide an accelerator around green building? So I think, you know, I think there's a lot of questions. You know, a shameless plug that on our blog we sort of thought through, you know, sort of 10 post-COVID-19 questions if people want to take a look, and they touched on some of those and more in much greater depth. But I think, as I said, you know, as of yet we haven't changed our ESG framework, but we're really starting to think about, you know, what the post-COVID world might look like, and, you know, how it's going to change how businesses run. And I think, as you know, because we're trying to look at the ESG issues that really affect a company's core business, I think it will ultimately, you know, sort of change how we think, you know, what are the really material, economically relevant ESG risks for companies.
Yeah, I think, I mean, it's an interesting question about this wave.
Peter, I think you might still be on mute.
Yeah, can you hear me now? Yeah.
Yeah.
So I think this question around ESG dimensions and the weight is interesting. I mean, it's definitely an area where we also quite keen, and an area where we are planning to do research where you might be able to sort of extract that from the market itself by modeling sentiments around the ESG dimensions, or looking at events that are taking place that would fall into the three dimensions, and looking at, for instance, how ESG funds change their positions accordingly, and that might give you an idea of what type of ESG dimension seems to lead to more or less reallocation of capital within funds, and therefore you can extract the current view of the market on what's most important. So, but you could argue that the investment process in sustainable investing reduces the risk of loss. We have definitely seen that there's good downside protection there. So reducing the risk of loss in your portfolio by avoiding companies that take too much risk and instead try to identify companies that focus on long-term sustainability trends. If that's true, such companies should become more relevant during the corona crisis, providing investors with better risk management and performance. In the recent period, how has the performance of ESG indices compared to that of more traditional indices? Have good ESG companies weathered the storm better than bad ESG companies?
Yeah, and I think if we flip to the next slide, yeah, and I think ESG indexes are sort of a proxy for ESG portfolios. We think about how is a basket of sort of stronger ESG names or a portfolio tilted toward sort of better ESG performers, companies better managing their ESG risks performed. And I guess one very big caveat is we're talking about an extremely short period of time. So I think you have to take it with a grain of salt that what we're seeing is just a few months of performance. But it's also interesting that I think we've been talking about the ESG momentum. I think you could say that this sort of ESG trend has been kind of really taken off in the last 10 years, and therefore this is the first bear market that ESG has really faced. So it's interesting to look at least over these first few months how has ESG performed. And what we've seen so far is that the ESG indexes have outperformed their parent benchmarks, and ESG as a factor has been a pretty robust defensive factor. As an aside, something that we recently launched, sort of coincidentally during the COVID crisis, is a new version of the BARA Global Equity Factor model with ESG as a factor. And what this allows investors to do is understand the specific contribution of ESG to that to performance. So the chart on the right helps us understand it's not quality, it's not cap or size, it's there's specific ESG explanations to the outperformance that we're seeing, and in many instances it's quite significant. It's the largest or one of the largest drivers for why the ESG indexes have outperformed. So we've seen outperformance. We've seen ESG kind of do well so far in the crisis, in this bear market, and with this ESG as a factor in the model, we've been able to say that it is ESG itself that is in part driving that outperformance.
I think there's an interesting question from the audience that also relates to performance. Or at least in some shape or form predictability, and how can the ESG metric be used to be forward-looking in portfolio management?
Yeah, and I think maybe historically ESG was sort of backward-looking. It's like the company has a big controversy, you give it a penalty flag, it's downgraded, it's now a problem ESG company. And really and we still have products that are designed to flag companies that have been involved in human rights controversies or discrimination controversies for our clients who don't want to invest in those companies that have been involved in those incidents. But what our ESG ratings are trying to measure are really trying to be forward-looking. We're trying to look at, again, which companies are more resilient, which companies are better positioned for these long-term trends, better positioned to not have these ESG incidents. And so we're looking at which companies have significant exposure to ESG issues and have demonstrated or do not have sort of the systems, sort of the performance that indicates that they can effectively manage those risks. So where we see that mismatch between kind of a lot of risk exposure and not a lot of evidence of effective management, those are the companies that we would say are the outliers. Those are the companies that we'd say on a forward-looking basis have a higher probability of having ESG incidents, have a higher probability of not being able to adapt to some of these rapid changes around technology, climate change, resource scarcity. So I think the ESG ratings are designed specifically to kind of try and capture that forward-looking kind of how companies are positioned for what's coming, not what's happened in the past.
So it's basically a sort of like a probability of seeing an ESG issue happening in the future that is sort of trying to be reflected a bit.
Yeah, I think, and some ESG issues occur a little bit more, data breaches or employee safety incidents happen a little bit, more short term, but there's, some of the other ones that you see materialize a little bit longer, kind of climate change and your ability to adapt to changing consumer sentiment or regulation. but all, the ratings hopefully are, predicting which companies are going to be better able to respond to these shorter term operational issues and these longer term kind of mega trends.
Yeah, so and I guess it also comes down to consuming different types of information. You have your ratings type of data, and then you have perhaps other data that looks at it from a shock perspective, that an ESG issue actually hitting, and sort of combining all of this information also with communication about policy changes within companies or and so on, also influencing what the risks are going forward for investing in these companies. So I mean, typically when we talk about ESG, we think about companies and how it relates to equity markets. I know that there was a question from the audience as well that talks about credit, how it relates to credit, but what about other asset classes? What's happening there?
Yeah, and I think, historically this was a large cap equity field, that was kind of where the demand was. That was where, sort of the initial set of asset managers were being pushed. That was where information was available, or that was where the assumption was that you could do ESG. But I think over the last, 5 years or so, we've seen a growing demand for, emerging markets, small cap equity, certainly investment grade credit, but increasingly, high yield, EM corporate debt, bank loans, hedge funds, alternatives, real estate, the demand for, broad kind of, our clients want to integrate ESG across all asset classes. So the demand for coverage, is ever increasing. And I think over those last 10 years, we've quadrupled our coverage. We're up to something like over 13,000 issuers. That links to over 650,000 equity and debt securities, and it's covering that broad range of asset classes. So it's not just equity, it's not just large cap equity. It's some challenging asset classes, emerging markets, small cap, high yield, and I think we'll touch on that a little bit later. I mean, there are challenges to covering those types of markets, but there are ways to do it, but the demand is certainly there, and coverage has had to respond as clients want to not just do this in a couple of portfolios, but want to do it across all assets.
Yeah, we have definitely seen increased interest from our clients also at the sovereign level, and trying to integrate country-specific regulations and stuff like that. What are they doing in terms of promoting women on the board? What are they doing in terms of human rights and stuff like that? So that obviously naturally lends itself to managing more fixed income based portfolios. Yeah. But if we look at if we look at the markets also within equities, I mean, some people argue that sustainable investing focuses on developed markets, primarily due to lack of data in emerging markets. Is that true, or can ESG investing easily be expanded into global markets, or at least how would investors be able to address this potential challenge?
Yeah, easily expanded? No. Can it be done? Yes. I think it is more expensive. It's harder to do it in emerging markets, to do it to cover high yield. It's I think speaking specifically of emerging markets, you need boots on the ground. You need analysts who speak the local language, who can scan kind of local publications in that local language. You need analysts who understand the local regulatory and business context. You need, and I think we're going to touch on this more later too, is you need, kind of AI, NLP techniques. You need alternative data, because the disclosure is not going to be there. So there's a lot of data out there, but you need techniques to be able to find it. And you also need to build out estimation models and other models that are going to sort of, approximate, looking at, what other peers are doing, or can assume, based on what local regulation is, what companies are doing or not doing. but but it can be done, and it can add value. And I actually think, if we flip to the next slide, it's just a chart of the MSCI emerging markets ESG index versus the traditional emerging markets index. And so I believe it's the ESG index that has outperformed the most in terms of the ESG versus their parent benchmark. And I think it speaks to that if you can effectively find the information, create a consistent signal, which I think we've been able to do. There's a lot of information value in being able to understand, what's happening at these companies, what's going on with their corporate governance, are there structures in place to, avoid corruption and insider dealings, is there infrastructure in place to, to manage these risks, rebound, be resilient, respond to crisis, and just, kind of have a better sense of what's going on at these companies. So I think it speaks to that, it's hard, it can be done, and if done well, it can provide some useful information.
Yeah, I mean, one of the things that you mentioned, of course, is very important to us as an NLP company in terms of how can we be useful for emerging markets investors. And one of the things that we are doing is really to expand our capabilities of analyzing text in multi-language. So we are basically at the moment working on expanding beyond English language text and into multi-language, covering 11 different languages that covers sort of the world. And that makes it a lot easier, of course, or is a requirement in order to be able to pick up from local press and so on, and more systematically or automatically incorporate sort of policies, changes, communication from companies themselves, but also when ESG events and often on the negative side actually takes place, right? So you can incorporate that faster into your modeling efforts. But it also leads us on to sort of the next question, and that is, traditional ESG scoring has been driven by human analysts. However, more recently, the focus has been on scalability, automation, including new data sources. What types of data and technologies will be driving ESG innovation in the coming years?
Yeah, and I think we I started to touch on that. I think we kind of a lot of things sort of a confluence. We were talking about coverage and the ever increasing demand from our clients to have more coverage. So throwing more people after the problem was not going to be a solution. It wasn't efficient, but it also the information was out there, but it wasn't necessarily out there easily collected by people. You needed machine learning, natural language processing, automated document acquisition. You needed to find alternative data to be able to make those assessments effectively. So I think increasingly we are we're leveraging those those techniques in terms of trying to gather the information that's out there. And maybe going back to what we were talking about earlier in terms of Equifax, we couldn't count on Equifax to tell us all about their data breaches and failures to manage data and privacy and security, but we found a database of kind of data breaches that we were able to use sort of natural language techniques to kind of comb through and find evidence that kind of supported the sort of the view that we already had that kind of helped provide that supporting evidence. And another area that we're using kind of these techniques is to help us refine our models, sort of more of in an R&D. I think we're using AI, NLP, et cetera, not just to find data, but to think about how do we refine our models, how do we kind of look at new data sources, how do we think about how do we look at companies. So one way is when we look at our peer groups, because we're looking at peer relative companies, and I think everything is kind of currently driven by the GICS industry classifications. But are there other ways to think about how companies are grouped? And so we've been starting to scan, the quarterly calls, looking at, what companies are saying about themselves, what investors are saying about companies, and sort of the risks and key issues, key risks that they're talking about as another way to group companies. So this is just trying to look at other ways that we might be able to use data, use sentiment, use NLP to kind of not just find data, but to kind of refine and enhance our model. So we're trying to use all of those techniques to innovate and kind of stay ahead of kind of what the ESG trends are.
Yeah, and I think probably some of these new techniques are required to really also live up to the regulation. I think I alluded to that a little earlier as well, in that, I mean, some of the regulation that is being discussed in Europe is really this ability to be able to react quickly if ESG issues arise, and preventing sort of portfolios to be what you would consider a little whitewashed, right? In that they probably may have been, have some companies in there that they probably shouldn't, or they may have been okay to have had before, but now something happened and you should take action on it. So all of this require faster technology and perhaps automation in order to cover large enough data sets. Otherwise, it becomes very expensive to run a pure analyst-driven process for that.
I was just going to add, it's not just portfolio kind of, it's also company greenwashing too. I mean, first and foremost, like, you need these techniques because there's a lot of companies that are not disclosing the information that's required. So you need to go and comb and gather information. But even if we get to a point where all companies are disclosing information, and even if it's highly regulated in terms of what they have to disclose, companies are always going to accentuate the positive and, talk about, their ESG issues in a positive light. So finding alternative data sources to the company disclosure, helps provide kind of an alternative point of view. So is what the company's saying kind of really the reality, or are they kind of accentuating the positives and kind of de-emphasizing sort of the negatives? So I think these techniques are, essential now and are going to be essential in the future, even as disclosure improves at whatever pace.
I mean, we're definitely seeing that when you already in news today, right? And you need to be able to adjust for these biases. If you look at overall news content, there is a 2-to-1 relationship in positive to negative news generally. If you go to press releases where it's in the control of the corporations themselves, for large cap, it's something like 4-to-1, where they probably have a compliance team that sort of tone it down a little bit. But if you go to small cap, it's probably more like 10-to-1. So for sure, you need to get sources that moves beyond sort of the pure corporate own communication stream, right? I mean, towards the end of last year, we put out a paper at Ravenpack that was utilizing or building on top of MSCI ratings, and some of that research that we did, and also some later research by Monarch University in Australia, showed that markets can also often overreact, especially to negative ESG sentiment. And as expected, I mean, companies that are exposed to such sentiments typically would underperform initially. So when this negative sentiment ESG events hit, they will underperform. But because of them overshooting, it becomes potentially a reversal signal in the longer run or in the midterm. And that's sort of what we're showing here on this slide. That's one of the key pictures from our study, just based on these more event-driven risks. This is of course not the MSCI ratings, but if you look at it pure from an event-driven perspective, it was quite clear to see about a week of underperformance, and then following negative sentiment events, you saw this sort of 3-month reversal pattern actually hitting. And if we go to the next slide, we actually show the performance of a strategy that would go long that would go long companies that have had a negative ESG sentiment, but wait a week and then buy it. And as you can see, it's been quite nice, consistent performance throughout the backtesting period, and where the green shaded area sort of reflects the out of sample performance. But if you look at it from an information ratio perspective, we were able to get a more than 1 in information ratio, even controlling for exposures to traditional risk factors. And here we use MSCI's GEM3 model, and we were able to achieve similar sort of performance as you would actually get from this shorter term 1 week signal, because you could benefit from a much more well-diversified portfolio when you hold for longer time periods. And we thought that was interesting, and this result has also been confirmed. This is for US, but Monarch University has also been looking at this and confirmed the results, and also have taken that result global. But with this sort of growing market of large asset managers focusing on ESG, and is regulation and these restrictive mandates not introducing new biases to company valuation? Are you seeing increased demand from hedge funds who wish to track ESG to be able to take advantage of these biases?
Yeah, so there's a lot in that question. Yeah, I mean, I think one thing is, I think many of our clients are not necessarily, using our ratings or our research, for, ESG mandates, say where they're required to sell companies with low ESG ratings, they're integrating it as a, a source of information. So, may not be that, they're all sort of holding good companies and not holding bad companies at this point. And I think, we are seeing a growing demand from hedge funds. I think, a lot of it's driven by sort of the demand drivers that we were talking about. And I think, also the view that there's signal value in the ESG rating. But I think some of them are and will, take, sort of start looking at kind of the short-term kind of signals that you guys are pointing to. The other thing I would just point out is, I think, as you said, you were looking at kind of ESG events and kind of response to those ESG events. And I think, our ratings are, take into account events, but kind of look, sort of more holistically at a broad range of issues. Some are shorter term, some are longer term. And what we've seen, kind of over the long term is that, companies with kind of positive momentum or sort of improving ESG performance, and kind of conversely, the companies that are, have negative momentum or deteriorating ESG performance have outperformed and consistently outperformed over sort of the 13-year period. And this is MSCI World that we're talking about, kind of large cap developed. So they've consistently outperformed over those 13 years. So it's had a lasting effect. So, sort of both of these phenomenons may be going on, that there's kind of, short-term, over and under reactions, but the market also is reacting kind of in a long-term sort of way to not necessarily our ratings, but to, the evidence of companies kind of improved ESG risk management or sort of, deteriorating ESG risk management. So it's kind of, some interesting, kind of signals to unpack there. But I think, we're to answer your question, we are seeing hedge funds that I think are sort of kind of looking at both of those, sort of the short-term and the long-term signals, and how, whether those can be exploited.
And also just to add, I mean, when we were looking into the ESG ratings, we found a similar thing, that good ESG companies generally did outperform bad ESG companies in the longer term. And we were also seeing, actually, if we started integrating sentiment into the mix, that we were actually able to further sort of enhance a potential signal, in the sense that you could be a good ESG company according to MSCI, but have negative news or have positive news, not necessarily ESG related, but just either positive or negative sentiment. And the same on the bad ESG rating side. And we could see that good ESG with positive sentiment, you would outperform good ESG with negative sentiment, who would outperform bad ESG with positive sentiment and bad ESG with negative sentiment. So they aligned very nicely. And that's also a way to perhaps combine data sets together in order to further protect the downside, as well as also ingesting ingesting alpha, so sort of alpha components into the ESG process. So that's one of the papers that we have made available. Both the Ravenpack version of that and the Monarch University is available as a resource that you can download here. But with the research overwhelmingly showing that ESG events affect performance, how should we think about the potential return sensitivity to new information when considering companies that are overwhelmingly held by large asset managers with specific ESG mandates versus those that are predominantly held by hedge funds with a subdued ESG focus? Will this affect sort of crowding measures? Is that sort of why perhaps hedge funds are thinking about bringing in this data? They want to understand potential crowding effects that are led by ESG.
Yeah, I mean, I think, and I'm conscious of time, I'll try and make a quick version. I think, to some of the things that we were just talking about, I'm, not sure that I think that many of the large asset managers are, looking at ESG, but not necessarily sort of just holding the good ESG stocks, and hedge funds are, kind of holding the bad ESG stocks. And not sure that, we're at a point yet where there is sort of that, kind of crowding towards, kind of the positive, or sort of the large cap names. I think it's, I think as I was saying, we have seen kind of that consistent outperformance on the momentum, positive and negative. So there is some lasting effects there that we see. So, but, that's kind of what we've seen so far. It's not to say that, as we see more drivers around regulation and drivers towards ESG mandates, that we might not see that, kind of that crowding, that that occurrence happen down the line.
I think before we sort of finish up, we have one question here on the next frontier. I think it's important that we get to cover that before we finish off. What will investors care more about over the coming years than what they are doing today, and how are data vendors trying to solve these problems in order to meet future demand and requirements?
Yeah, I mean, I think if I was going to say something, it would be climate. I think, climate is, we're seeing, like, compared to sort of how quickly ESG was adopted, climate is being, much more rapidly adopted, kind of, it's sort of following a similar trajectory at a much faster pace than sort of traditional ESG. And I think it's been helped by a lot of the factors that you were already talking about: regulation, sort of climate regulation in the EU, some of the quasi-regulatory drivers like the PRI, Principles of Responsible Investment, requiring asset managers to report on their climate risk management capabilities. So I think climate is going to be the topic that everybody is kind of really trying to figure out. And what we're trying to do is we acquired a company called Carbon Delta late last year, and have integrated that to launch a new product called MSCI Climate VaR. And really what that's trying to do is a lot of these risks are still pretty unknown. Is this going to be transition risk as we move to a more low carbon economy, or is it going to be physical risks because temperatures continue to rise and there's going to be extreme weather, and and extreme events like that? But what you can do with this new Climate VaR tool, and what it's required by a lot of this regulation, is to do scenario analysis. What does our portfolio look like if the planet warms by 4 degrees? What if it warms by 5? What if it's regulated and only warms by 2? What is the impact on portfolios? What might the financial risks and the financial implications be under these different scenarios? Help clients understand their climate risk, under different scenarios, to kind of, sort of meet this sort of critical risk management requirement, but also sort of this regulatory requirement as well. So I'd say, in a word, climate.
Yeah, I think, we probably have to finish up shortly. I have a last question that I'll try to address, sort of my final comments here. And I just wanted to highlight that we at Ravenpack, we support the further adoption of ESG principles in investing. And we have made that a strategic focus to continuously develop technology that will help asset managers to achieve better and more efficient ESG workflows, providing not only sentiment around companies as they develop their internal ESG programs and communicate with the market about these, but also to inform about when negative ESG events do hit. And our process is very much taxonomy driven, in the sense that today we cover more than or close to 7,000 different types of what we call actionable events. And that's both related to things that are actually happening now, or also things that are expected to happen, or when companies or people, various people, provide guidance on certain issues. And we are working quite extensively of expanding our existing capabilities of picking up ESG events to an even larger set of ESG events that we're picking up. So we are integrating a lot of the well-known sort of taxonomies. There's not one sort of taxonomy that has sort of won, but so we have sort of been integrating a lot of or various materiality maps and so on as it relates to ESG, such that as an asset manager, you're able to measure the sentiment around the programs in place, as I mentioned, but also picking up on when actual ESG issues hit, and you can take action on that. I mean, we are also very much focusing on policies and regulation that could impact ESG requirements put on top of companies across the globe. And that should also prove useful in more emerging markets, to see if they will also be operating under stricter regulation there. But overall, stay tuned, as there will soon be more exciting news coming from Ravenpack as it relates to ESG, going beyond what we're already doing in the space. But before we finish, again, I'd like to thank you all for joining. I hope that you have found it useful and entertaining. And as already mentioned, the session has been recorded and will be made available after the event. Also, I'd like to thank our guest speaker, Noel Friedman, and MSCI for participating. I found the insights extremely valuable, and I hope that you agree with me on that. So if you haven't done so already, I'd like again to highlight that you can still download the research papers from Ravenpack and from Monarch University addressing ESG and coronavirus panel topics. And we have also included a video introduction to our publicly available coronavirus monitor if you wish to keep track of what's going on in that space. We are not quite over with that yet, unfortunately. So with that, I would like to thank you all and have a great rest of the week. Thank you.
Thanks, Peter. Thanks, everybody.
This is Ravenpack.